uncertainty of the new trading regime has already negatively affected employment levels in my own country, South Africa, and is an obstacle to our economic growth. We are therefore supportive of meaningful BRICS initiatives that improve the resilience of our economies as BRICS countries and those of the global South.
China continues to have its eyes on Africa. While the relationship between African countries and China has grown over the years, China is looking to deepen and strengthen its connections with the continent over the next 10 years. We'll get into how and what this also means for others trying to get in good with the continent.
Well, the relationship between China and Africa has been growing in recent years, with African countries signing numerous collaborative agreements with the Asian economic giant.
For decades, the United States sat at the center of global trade. Money moved through American-backed systems, deals were settled in dollars, and Africa, despite its vast resources, was treated as the outer edge of the global economy. But that order is quietly shifting. While attention was focused elsewhere, Africa and China sealed trade agreements large enough to reroute supply chains, and they did it without Washington at the table. No dramatic announcements, no public confrontations, just contracts signed, infrastructure activated, and commodities moving in new directions. America isn't stunned because this came out of nowhere. America is stunned because this shift can no longer be controlled. For most of the modern era, global trade followed a predictable path. Goods moved through systems designed and dominated by Western powers. Financing flowed through institutions shaped by U.S. influence, and the U.S. dollar functioned as the default language of commerce. Africa was deeply connected to this system but rarely empowered by it. Despite holding some of the world's most valuable resources, African nations often negotiated trade from positions of dependence rather than strength. Commodities were exported raw, prices were set elsewhere, and economic growth was constrained by infrastructure. Gaps and financial limitations. China approached the continent differently. Rather than focusing on political alignment or ideological frameworks, Beijing focused on something more practical: movement, the ability to move goods, energy, and materials efficiently across borders. Ports were expanded, railways were built, roads, power plants, and industrial zones followed. These projects didn't dominate headlines at the time, but they quietly laid the foundation for a new trade reality, one based on logistics rather than diplomacy. As China's own economy expanded, Africa became central to its long-term supply strategy. Energy resources, critical minerals, agricultural output, all were essential to sustaining growth. But rather than extract value alone, China structured trade around long-term agreements tied to investment and infrastructure. Over time, these links deepened. China emerged as Africa's largest trading partner, not because of a single breakthrough, but because of sustained engagement. Trade volumes increased, supply chains tightened, and financial arrangements began to evolve to support the scale of exchange. This is where the current moment becomes significant. The recent Africa-China trade pacts aren't one-off agreements. They represent layered cooperation across commodities, manufacturing, agriculture, and logistics. Taken together, they form an alternative trade architecture, one that functions alongside the traditional Western system rather than beneath it. What makes this development so striking is what it doesn't rely on. Many of these deals reduce exposure to the US dollar. Settlement increasingly happens in local currencies or through alternative financial channels. Clearing doesn't always pass through Western institutions. Risk is distributed rather than concentrated. For African economies, this provides flexibility they have rarely had before. It reduces vulnerability to external shocks tied to U.S. monetary policy. It lowers transaction costs, and it creates room to negotiate trade on terms that include processing, value addition, and technology transfer. In short, Africa is no longer just exporting resources, it's shaping relationships. For Washington, this presents an uncomfortable reality. U.S. economic influence has long depended on the centrality of its currency, its financial systems, and its position at the heart of global supply chains. When trade begins to flow outside those channels, leverage weakens quietly without confrontation or crisis. That's what makes the Africa-China shift so powerful. It doesn't reject the West. It doesn't announce a new bloc. It simply creates options, and in global trade, optionality equals power. As infrastructure locks in new routes and long-term contracts secure supply, trade patterns begin to harden. Once goods, money, and logistics adapt to new pathways, reversing them becomes costly and unlikely. This is where momentum takes over. Each new agreement encourages the next. Each successful settlement outside traditional frameworks builds confidence, and each shipment that moves efficiently without dollar dependence normalizes the alternative. From the outside, the change looks gradual. From the inside, it feels decisive. The United States is not losing relevance overnight, but it is facing a future where influence must be negotiated rather than assumed. Africa's growing role in global trade and China's willingness to meet it on pragmatic terms signals a world moving toward diversification rather than dominance. And as this new architecture solidifies, the question is no longer whether global trade can function without America at the center. It's how often it already does. By the time the United States began publicly reacting to Africa-China trade deepening, the momentum was already well established. That's because this shift wasn't driven by ideology or confrontation, it was driven by necessity. African economies are growing rapidly, but growth requires predictability. It requires stable demand, long-term financing, and trade systems that don't collapse every time global interest rates rise or geopolitics shift. For years, reliance on Western-centered trade and finance meant exposure to decisions made thousands of miles away. China's appeal lies in reducing that exposure. As Africa's infrastructure expanded, so did its negotiating confidence. Railways meant landlocked countries could export competitively. Ports meant faster turnaround for goods. Industrial zones meant value addition could happen locally rather than abroad. Trade stopped being extractive by default and started becoming strategic. This is why recent Africa-China trade agreements feel different. They are not simple buyer-seller arrangements. They are integrated frameworks that link supply, transport, processing, financing, and long-term demand. And critically, they allow trade to continue even when Western systems become unpredictable. The US dollar still dominates global finance, but dominance isn't the same as exclusivity. What Africa and China are building is redundancy, the ability to trade even when traditional channels are constrained. That changes the balance of power. For decades, US leverage rested on a simple assumption. If something went wrong geopolitically, access could be restricted, financial pressure could be applied, markets could be closed, but leverage only works when alternatives are limited. As Africa expands trade corridors that don't rely entirely on Western clearing systems, pressure becomes less effective, not irrelevant but diluted, and diluted leverage is far less intimidating. This is especially true in commodities. Africa supplies the raw materials that power modern economies: copper for electrification, cobalt and lithium for batteries, rare earths for technology, agricultural output for food security. When these commodities are locked into long-term trade frameworks tied to infrastructure investment, the exporter gains stability and the importer gains security. China understands that security of supply is just as important as price. By securing access through partnerships rather than spot markets, it reduces vulnerability to shocks. By settling portions of trade in alternative currencies or structured arrangements, it reduces financial friction. None of this requires replacing existing systems, it only requires supplementing them. That's where Washington's unease grows, because the shift isn't loud enough to confront, but it's too significant to ignore. Traditional tools such as tariffs and sanctions are designed for a world where trade routes are centralized. When supply chains fragment and reroute through multiple hubs, enforcement becomes harder, costs increase, political consequences multiply, and that leads to restraint, which is exactly the point. African governments see this clearly. Diversifying trade partners isn't about rejecting the West, it's about avoiding dependency. When a country can sell commodities east and west, borrow from multiple sources, and process goods domestically, it gains negotiating space. That space is power. This is why the narrative of choosing sides doesn't fully apply. Africa isn't choosing China instead of the US, it's choosing options instead of dependence. And that distinction matters, because it makes the shift durable. It reduces backlash. It normalizes cooperation across blocs. From the outside, this looks like gradual diversification. From inside government planning rooms, it looks like risk management. The acceleration comes from one simple realization: the global trade environment is no longer stable enough to rely on one center. Interest rate cycles in the US ripple worldwide. Sanctions regimes expand unpredictably. Trade rules shift with elections. For developing economies, these external variables introduce volatility that undermines long-term planning. Africa-China trade frameworks offer something different: predictability through structure. Infrastructure locks in routes, long-term contracts lock in demand, development financing tied to trade locks in continuity. That combination is powerful. It also explains why this movement spreads regionally. Once one country secures better terms, neighbors take notice. Once one corridor proves efficient, others replicate it. Trade networks behave like ecosystems. Once conditions improve, growth accelerates naturally. This is why Washington's response often feels reactive. The assumption was that influence would erode slowly, if at all, that alternatives would remain marginal, that inertia would favor the status quo. What was underestimated was how quickly confidence can shift once systems start working. The moment trade flows reliably without disruption, fear disappears, and once fear disappears, experimentation accelerates. This is the quiet tipping point. The United States still matters enormously in global trade. Its market is huge, its financial system is deep, its innovation remains unmatched, but it is no longer the only gatekeeper, and in global systems, losing exclusivity is often more consequential than losing dominance. Africa's rising role magnifies this effect. With the world's youngest population, vast untapped markets, and strategic resources, the continent isn't just participating in global trade, it's shaping its future structure. China's role is catalytic, not singular. Others will follow. Regional trade within Africa itself will expand, south-south. Cooperation will deepen. A world where trade routes overlap, where currencies coexist, where leverage is shared rather than monopolized. For the United States, this demands adjustment rather than denial. Influence will increasingly depend on competitiveness, partnership, and mutual benefit, not assumption. And that brings us to the final question, which defines everything that follows. If the center of gravity in global trade is shifting, what does that mean for America's economic power at home, for the dollar, for debt, and for long-term stability? That's where the consequences stop being abstract and start becoming personal.